Global equity markets have been somewhat more volatile in 2014 due to a number of concerns which have arisen in recent months, but nevertheless are down only 0.4% year-to-date to the middle of March. This chart highlights some of the key market drivers since the beginning of the year. Initial concerns over possible contagion from slower growth in emerging markets to the global economy, combined with fears of credit defaults in China's shadow banking sector, which could threaten Chinese growth, both contributed to falls in equity markets in late January. At the same time, following one of the most severe winters in the last 50 years, US economic data began to disappoint, which led to questions over the underlying strength of the US economy. From early February, markets began to recover, as it was believed the most vulnerable emerging market economies were too small in the global context to have a significant negative impact on the world economy. While it was also thought that the Chinese authorities have sufficient resources at their disposal to deal with any problems in the shadow banking sector, thus enabling a hard landing in the Chinese economy to be avoided. With regards to US economic data, while releases remain mixed, there has been some improvement in recent weeks, and while first quarter GDP will probably be low, a recovery and rebound is expected in the second quarter and remainder of the year. Developments in the Ukraine gave rise to uncertainty in March and have had a more noticeable impact on European markets. While it is difficult to predict how political events will evolve, given economic dependencies and the fact that it is not in the interest of the various parties involved for tensions to increase further, we believe the situation will not escalate to the point where it becomes a significant negative for markets. In the last day or so, the US Fed has abandoned its guidance on interest rate policy around threshold levels of unemployment, as has the Bank of England. Both central banks have, however, indicated interest rates will still remain low for a considerable period, with eventual rises being gradual and likely to settle below previous norms. In Q&A post the Fed meeting, Janet Yellen, the Fed chairperson, indicated interest rates could rise around 6 months after QE3 tapering ends, and thus could increase in March 2015, causing equities to sell off slightly. Rising interest rates, however, are not necessarily negative for equity markets, as history shows. This table shows equity market performance for the 12 months prior to the beginning of interest rate rises in the US since 1954, and the performance over subsequent periods over the following 12 months. As can be seen, on average, equity markets perform well in the 12 months before rates rise. 1 to 3 months after the initial rise, markets tend to be flat and can sometimes fall slightly as it comes to terms with rising rates. Typically, however, 12 months after the initial interest rate rise, equity markets are up around 9%, as the improving economic environment, which led to the rise in rates, is supportive of equity market fundamentals, as is likely to be the case on this occasion. In relation to bonds, as can be seen, global bonds have benefited and yields have fallen year to date on concerns over slower US and global growth and the relatively low levels of inflation, while the various global tensions and uncertainties have also contributed to a flight back to perceived safe haven assets. With concerns over growth probably overdone, and with economic growth expected to pick up again in coming months, bond yields should begin to rise again, while recent speculation over the timing of interest rate rises should also push yields higher and lead to lower bond prices. While equities have had a slow start to the year, we believe they still offer upside over the course of 2014. The US economy should recover from the weather-related weakness and see improving momentum in coming months, while recent data in the UK, but particularly in Europe, has been stronger and has led to upgrades to growth forecasts. While the US Fed is reducing the level of stimulus through QE3 tapering, monetary policy still remains loose, and interest rates are unlikely to rise in either the US or the UK for at least another 12 months, while the Bank of Japan and possibly the ECB could introduce additional measures. Equities remain attractively valued for this stage of the economic cycle, while they remain particularly attractive against other asset classes such as bonds, from which we expect negative returns over the remainder of the year.